Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Skyler Fernandes of Venture University. Sky, thank you for joining us.
Hey, thanks for having me.
Great. Can you tell us a little bit about your background before you got to your current position?
Sure. Yeah, I've been doing venture capital now for a little over a decade, a little over 10 years. Initially started off doing traditional venture capital for about 5-6 years, the venture fund in Connecticut, where I was really focusing on really everything. It was a generalist role, investing in everything from retail to healthcare to energy to nanotechnology. And during the time there, kind of built up my initial skill set in doing venture capital and private equity. I then had the unique opportunity of launching a corporate VC for Simon Property Group called Simon Venture Group. Simon Property Group is it's an S&P 100 company, largest retail real estate company in the world. And they asked me to create their corporate VC that was going to be focusing on fashion brands, fashion kind of retail technology, and real estate technology. And so I was there for a little over 3 years, a little over 30 investments while I was there. And then while I was there, I ended up got introduced to one of Simon's board members, a person named Don Thompson, who's the former CEO of McDonald's. Don was at McDonald's for about 25 years, president CEO for 5 years. And he got introduced to me saying he's looking for someone to advise him on creating a venture fund, private equity fund. And about 6 months after I was introduced to him, Don ended up launching Cleveland Avenue in Chicago, which is a $150 million VC private equity fund focused on food and beverage and new restaurant concepts. So I left Simon Venture Group to create Cleveland Avenue with Don and was there for a little over a year. We deployed about half the capital in about 10 companies. And it was really there that I ended up brainstorming what Venture University is. And we launched Venture University now a little over a year ago.
So what does Venture University focus on?
Sure. So Venture University is a multi-stage venture fund, primarily focused on the seed and Series A stage, but we look at growth equity as well. We're divided up, focused on 5 kind of core verticals that really make us industry agnostic, but we have 5 different deal sourcing teams focused on 5 verticals. So we focus on consumer, enterprise, Fintech and blockchain, healthcare, and frontier tech. And frontier tech is pretty much everything that doesn't fit into any of the other categories, whether it be robotics, AI, quantum computing, space technology. And then Venture University really came out of, after doing VC for about 10 years, realizing that there needed to be a new model for venture capital. I looked at the industry where startups themselves are highly scalable, where they're constantly creating efficiencies, and there's more and more startups being created every year using less and less capital to get to revenue traction. And so there's this rise in the number of startups that are being created more capital efficiently. And you also have startups that are being created not just in Silicon Valley, but across the United States and global. So you have this large growth of deal flow. So while startups are scalable, the venture fund model is not scalable. So you have the management fee of a typical $100 million fund. If you have a 2% management fee on that, you only have $2 million really to support a team of somewhere between 3 and 7 people. And a typical fund of that size would typically only look at 1,000 to 2,000 deals a year. So you have a business model for what a venture fund is that's not scalable, where they can only look at this fixed amount of roughly 1,000, 2,000 deals a year, while the number of startups is continuing to increase. So the percentage of deal flow that a traditional fund looks at is actually, they're looking at a smaller and smaller percentage of deal flow every year going forward. So I was trying to think of what could you do to create a highly scalable venture fund? And that's part of what's baked into Venture University's model. We see probably, I think we're on a run right now of about 8,000 deals. So we see about 2,000 companies a quarter. So at 8,000 deals, we're looking at multiples of what a traditional fund looks like and looks at. And if you look at like an Andreessen Horowitz or an NEA, kind of multi-billion-dollar funds, they're looking at like around 3,000 to 4,000 deals a year. We're about 2 to 3x even what the multi-billion-dollar funds are looking at. And then the last problem we were solving is the way that people typically get into venture capital is by going to great business schools. They go to a great undergrad, or they work in an investment bank or a top consulting firm. Challenge is that none of that provides actually any relevant investment experience. And so we want to create really a trade school that was training people to get into venture capital and private equity or go launch their own fund. So the Venture University model is really part venture fund and part university, where people are applying to join our investment fund on a quarterly basis. And so we have the current cohort's about 5,000 people that applied, and we selected around 25 people to join the cohort. So about a 0.5% acceptance rate, making it more competitive to get into than the top Ivy League school or top MBA program.
So how do you process such a large number of applications and differentiate yourself from just a standard traditional VC?
Sure. Yeah. So two sides of that. One, we have a large intake on the people that are joining the investment team. So the 5,000 people that are applying, we have a full-time admissions team that are reviewing those. We do about 30 phone interviews a week to select the people to join the investment team. And we also have an application process that kind of helps filter that down to a smaller pool. But on the deal flow side, kind of our way of processing that really has to do with the fact that we have a much larger investment team than a typical fund. So again, most teams are around, if you're a $100 million fund, you're usually going to be around 3 to 7 people. We're around 35 to 40 people on our investment team. So we have a much larger number of people to really source that deals and review those deals. And we now have 5 people in Chicago, and we're in the process of launching in New York City either at the end of 2019 or early 2020. When we do that, we'll be doubling our deal flow even more. We'll be going from about 8,000 deals to 16,000 deals per year. And then we'll be having about 40 people on the team, closer to 80 to 100 people on the team. So part of it has to do with the fact that we have a much larger investment team to review all those deals, but we also have a process in place to do that. So we do a very unique structure, which we call a Scrum Agile methodology, where every week, we look at every week as a sprint, and each of the 5 deal sourcing teams prepares on Tuesdays how to maximize deal flow velocity every week, to go out, and every deal sourcing team looks at about 50 companies per week. And at the end of every week, they narrow it down to their top 2 deals. And on our partners meeting, which is also morning of Tuesdays, every deal sourcing team presents their top 2 deals. And over the course of 11 weeks, they're consistently competing their top 2 deals against the previous week's top 2 deals out of their new batch of 50 companies. And so over the course of about 11 weeks, we'll look at 2,000 companies and then narrow it down to our top 3 to 6 investments that we'll make.
So what type of investors or startups are you looking for? What's the criteria that gets them into those top 2 slots?
Sure. Yeah, great question. So internally, we have 14 kind of key criteria that we evaluate. But if we kind of focus on what are the most important ones there, I'd probably break it down to kind of top 3 criteria. One is market, second is team, and 3 is kind of product strategy, to kind of be the real quick whether we would even do a meeting with the company for just the first, because of the 50 that we'll source, we'll probably do a meeting with maybe a quarter of those companies. So just to get to the meeting, you probably really want to nail these first 3, and it's in the order of importance for a variety of reasons. So market, team, and product strategy. A lot of people say, and I think it's more of like the MBA answer, that it's all about team. And after doing VC for 10 years, I think team is really important, but I actually don't think it's the number one important thing. The reason that it would be market, team, and product strategy is you can have a really great team and you can have a really great product strategy, but if you're not going after a huge market, then you can't have a huge opportunity that's going to exit for multi-billions of dollars. But you can have a huge market with a mediocre team and a mediocre product and actually do quite well and even get acquired even if you're pre-revenue sometimes. We're very early revenues for a lot of money. So it's in the order also of what you can't change. You can't change how big the market is. It has to already be big or likely to be big in the future. You can change your team. It's painful, but you can change team members. And the easiest thing to change is your product strategy. If you have a great team, you can pivot your product strategy. So it's an order of how hard it is to change those things. It's also in the order of why a potential acquirer will acquire you for the most amount of money. Ideally, when they acquire you, that's day one for when they acquire you. And they need to hope that there's a much bigger market that they can grow into after they buy the company. So having the big market really is number one priority, is kind of what we look for is, do you have a truly large market? And I think a lot of times entrepreneurs underestimate the importance of that or understand the scale of what kind of a good market is, a big or huge market is, and what a ginormous market is. And that's the big difference between, I think, what you see a lot of top tier VCs investing in and what kind of earlier VCs are still learning how to do what they're doing, is really the scale of the startups that you're going after for what their potential is.
Well, great. Well, you invest in a number of sectors: consumer enterprise, fintech, blockchain, and more. How do you see those industries evolving these days?
Sure. Yeah, probably like blockchain's probably been the newest platform play that really affects every single industry. That's similar to AI in the sense that AI itself really isn't a sector either as blockchain. They're more platform plays that affect all industries. If we think of on the AI side, I think the beauty of that is that you're just getting this hyper functionality that you just couldn't have had before, or an efficiency of getting to certain conclusions that don't require humans. That itself is vastly useful. And then same thing for blockchain. Probably what I'm seeing blockchain disrupt the most right now is on kind of the future creating liquidity in places that have historically been illiquid assets. So real estate, venture capital, and private equity are illiquid assets. They're private companies. You own the asset. I think the tokenization of venture funds, private equity funds, and tokenizing real estate is probably one of the most exciting things right now that's happening kind of on the blockchain. And that's one that we're certainly spending a lot of time looking at is, should we tokenize ourselves as a fund? There's some pros and cons to tokenizing yourself. So I think there's a first few companies that are giving it a go. We're going to kind of see how that goes and then see if we can do a better version of it as that kind of matures. But I think that's going to be huge. I think the strategies that hedge funds use are going to start being applied to real estate assets and portfolios of venture funds and private equity funds once they'll be able to be traded just like public equities.
Well, blockchain's gone through its irrational exuberance, and now it's crashed and is coming back up with more realistic expectations. How do you see the landscape for investing in this sector?
I think you reference more on the crypto side than on blockchain itself.
Well, blockchain and crypto were somewhat intertwined, and I think people are now teasing those apart a little bit here. But a lot of the crypto world, I think, drove a lot of the speculation that carried blockchain along. And I heard many investors say, I love the blockchain. I'm not so sure about this ICO thing going on, though.
Correct.
And that's kind of gone away now as far as an issue, and people are looking at the practical use of blockchain, standard startup metrics apply here, and just want to see how you see blockchain evolving as an enabling technology.
Yeah, no, I think for us, we're very bullish on blockchain in general applied to really any industry. I think that we have to be mindful of it. We've seen a lot of pitches that are just adding blockchain in because they can. It's the same thing that you see happen with AI, that a lot of companies call themselves an AI company or a blockchain company, but their business model would work just as well if they weren't using AI or blockchain, and they might not actually really be using real AI. So I think there's a little bit of an honesty aspect of that you really want to make sure that is there a real benefit to actually using blockchain, or are you just adding it in because it's sexy? I think one sector that we're looking at on the kind of crypto and blockchain side is on hedge funds and how to do transactions really quickly and tracking them. Let's say that our Fintech blockchain team we're potentially going to be making an investment in the next few weeks on a company that helps really centralize the trades that are happening to hedge funds that can be tied to crypto, but for tracking purposes. So I find that very fascinating. I think of other sectors that we're kind of really bullish on right now. The healthcare space has certainly become big for us. One place we found a big arbitrage is on where you're getting surgeries that are really expensive. So you think of plastic surgery, dentistry, hip replacements. We found that there's actually a quite big arbitrage of where it's done and the price and the quality, where this kind of what's been a very much more of a controversial space of medical tourism, where you'll travel to some foreign country to have an operation done. That's becoming a lot more streamlined and commercialized in the mainstream. And so we looked into, for example, the cost of a hip transplant in San Francisco versus the hip transplant cost in Middle America is like $80,000 versus $15,000, and the quality is just the same. You have like the top person in Kansas or Idaho who does hip transplants. And so I think if you can move the demand around based on location and kind of elevate it to where it's been vetted and there's some transparency on pricing, I think that's going to be a really interesting space. And so we did a market thesis around that, and we identified a company called Kuno Medical that we invested in at the end of last year. And Kuno Medical kind of does exactly that. They have a marketplace of doctors they're vetting the doctors to make sure that they're high quality, that they're actually doctors, and they're getting you set prices. So you don't even have to do any of the haggling. You know what the plastic surgery is going to cost or the dentistry is going to cost if you go to Hungary or Turkey before you get there. So I think that's going to solve a huge amount of the huge healthcare costs that the United States has, but also kind of the healthcare costs globally.
So what are some of the challenges in, say, the medical tourism space? It seems like a lot of people are moving into it, but as all good industries are, there's always risks and challenges that come with them. What are the challenges there?
Sure. Yeah, no, absolutely. I think one of them is really the vetting of the doctors to make sure that they're truly qualified to do what they're doing. You want to make sure that you're not sacrificing quality, given that you're also dealing with your own personal health, that you don't want to just be sucked in for getting a great deal, but then find out that things went wrong afterwards. So the screening of that is highly important. The other thing is making sure that how the payment is actually done. Different countries have different type of systems for how things are paid, where some of the things might be a lot more out-of-pocket expenses versus insurance, and making sure that if you do use insurance, there's an easy way of making sure that there's a kind of a fair market rate that the insurance groups are paying. That's one of the most challenging parts of this, but a very doable thing as well, which is, can you kind of standardize what a hip transplant cost is across a large network of doctors? So you don't have to kind of you don't have to negotiate that every single time you're having something done. So part of that really creates a proprietary set of data of kind of proprietary agreements that have already been set on a marketplace like that.
Well, it's great. Well, in the last few minutes of our interview here, what else should we cover that we haven't?
Well, I think we're understanding where venture capital is going right now. I think is a really interesting topic. You have, like, last year you had the whole venture capital asset class. There was about $130 billion that was deployed, and if you compare that to SoftBank, the Vision Fund that is $100 billion, we're entering a world where you have one fund that is the same size almost as all the assets that were deployed in the same year. And you have multi-billion-dollar funds like Mary Meeker's new $1 billion plus fund, who just left Kleiner. You got Sequoia raising $9 billion fund, NEA raising a $6 billion fund. We're entering into an ecosystem where funds are getting bigger, but you also have where micro VCs are also on a rapid growth. So funds that are under 100 million, call it $1 million to 50 million for the most part, a huge increase year over year in growth of these micro VCs. And we're entering into a world where both ends of the spectrum are really growing. And what's going to be really the missing piece is going to be talent. I think the fact that all these first-time fund managers that are raising capital, doing venture capital, that have no investment experience, I think is a scary thing. And also to be able to make sure you have constant new blood going into the venture capital and private equity industry, there isn't really a great place other than for Venture University, why we created it, is to make sure that part of our core vision is that the future will be a higher quality talent pool getting into venture capital that actually knows what they're doing. So I think that the whole ecosystem is interesting right now and how that's evolving, where it's no longer finding capital at the B and C stage is quite easy now. Now you have kind of the building out of both ends of the capital spectrum of what venture capital is.
Well, that's great. Well, how best for the audience to get back in touch with you?
Best way is probably on our website, venture.university, or you can reach out to me on LinkedIn as well.
That's great. We'll put that in the show notes. Appreciate you sharing this with us today and hope to have you back for a follow-up soon, and appreciate your time.
Absolutely. Thanks.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.